Hi everyone, Tommy Lim here from SF Capital, and welcome again to another Finance Mythbusters, a video series where we look at the common challenges business owners face when getting a loan. Today, we'll be looking at a myth relating to purchasing your business premises. That is, if I can afford a commercial rent, I can afford a commercial property. Are you a business owner that is currently renting your business premises and thought to yourself, what if I could buy my own commercial property? Perhaps you're thinking, if I can afford to pay the rent, surely I can afford to buy the property. While the ability to pay the rent is a major consideration, it's not the only consideration. And today, I want to unpack the key criteria that the bank looks at when looking to give you a commercial property loan. The first item that stops a business owner from purchasing a commercial property is the size of the deposit required. Unlike a home purchase, which may require a deposit of 10% or less, the deposit required for commercial property typically starts at 20%, but is more like 25 to 35% for a standard commercial purchase. This can be even as high as 50% for a highly specialized or remotely located asset. Taking a $2 million property and a 25% deposit as an example, many business owners also think that the upfront cash required is only $500,000. This is not correct. You'll also need to budget in transaction costs. So for a $2 million purchase, you will also need to incur stamp duty of $95,000, valuation and legal fees of $5,000, and lender establishment fees of up to 1%. These all add to the upfront costs of buying a commercial property, which make a $2 million property cost $2,115,000. You may also have to pay for GST if the property is bought with vacant possession, and you should speak to your accountant or your lawyer so you can understand if you need to budget these upfront costs into your property purchase. The second factor to consider is whether you can actually afford the loan repayments. While it is generally true that an interest-only loan repayment may be comparable to the current rent that you're paying, a principal and interest loan repayment may not be. This is especially the case due to the shorter-term nature of commercial property loans. Going back to our example, assuming a 3.5% interest rate, the interest-only repayments on a $1.5 million loan are indeed quite affordable at $4,375 per month. However, the P&I repayment, assuming a 25-year loan term, is $7,509 per month, and on a 20-year loan term is $8,669 per month, and even higher on a 15-year loan term. So when deciding if you can truly afford the loan repayments, you need to think about whether you're only maintaining the loan, that is, paying interest only, or paying down the loan over time, that is, paying principal and interest. You also need to consider the time that you have to pay back the loan, whether it's 25 years, 20 years, or even 15 years. Where a bank may give you 30 years to repay your home loan, a commercial property loan set to principal and interest repayments may only be 25 years, 20 years, or even less. This means for a commercial property loan, you have less time to repay the same amount of money compared to a normal home loan. The third consideration when borrowing for a commercial property is your assessment rate. Just because you think that your business can afford the loan repayments doesn't mean that the bank thinks the same. This is because a bank adds a loading to your actual interest rate to test your loan servicing at what they call the assessment rate. This is typically 2 to 3% higher than what your actual interest rate will be. The bank does this to make sure you can continue to afford making your loan repayments should interest rates rise, as well as to protect the bank should you experience a downturn in your business. So applying an assessment rate of 6%, which is a 2.5% loading to the previous interest rate of 3.5%, you can see how your loan repayments are tested at a higher amount when looked through the eyes of the bank. An interest-only loan repayment is now $7,500 per month. A principal and interest loan repayment on a 25-year loan term is now $9,665 per month. For a 20-year loan term, $10,746 per month. And for a 15-year loan term, $12,658 per month. The fourth and final consideration when taking on a commercial property loan is, can you continue to also pay your existing debts? Similar to how a business loan impacts your personal borrowing capacity, your personal loans, including your home loans, can impact your business's borrowing capacity. As we've seen in previous videos, as a business owner, your income and your business's profits are so closely connected that you can choose to use the profits of your business to pay down your personal debts should you choose to. This means that the bank wants to make sure when you take out a commercial property loan that you're not impairing your ability to make your home loan repayments, or impairing the ability to repay any existing loans within your business, such as car loans, equipment loans, or overdraft facilities. Basically, the bank does not want to see you on the street for the sake of your commercial property. So I hope this breaks open the myth, if I can afford a commercial rent, I can afford a commercial property. If you found this information useful, please like and share this video, as well as follow SF Capital on social media. Thank you for watching, and I look forward to seeing you in the next Finance Mythbusters.